How to convert nominal to effective interest rate, a student's guide. Have you ever wondered why the interest your savings earn doesn't match the rate advertised by your bank? Understanding both nominal and effective interest rates can unlock the mystery, aiding you in making smarter financial decisions. This video will transform the way you approach interest rates. A nominal interest rate is the rate quoted by financial institutions. It's the basic rate before accounting for compounding during the year. Whether you're looking at loans, savings, or investment products, this rate gives you a starting point for understanding interest costs or earnings. Imagine an advertisement declaring a 6% annual interest rate. That 6% is nominal. However, it doesn't reflect the true interest you earn when compounding is included. Understanding nominal rates is essential for interpreting the initial offers you receive from banks or investment firms. Conversely, an effective interest rate reflects the full impact of interest compounding. This rate is what you truly earn or pay annually. It accounts for the frequency of compounding, monthly, quarterly, daily, thus giving a more accurate representation of financial costs or gains. Understanding the effective rate is crucial because it reveals the actual cost of borrowing or the real return on investments. For instance, a nominal rate of 6% compounded quarterly results in an effective rate higher than the initial 6%. This insight can significantly influence financial planning. Converting nominal to effective rates involves a straightforward formula. Effective rate equals 1 plus nominal rate / NN, 1. Here, N is the number of compounding periods per year. By plugging in the numbers, you convert the advertised nominal rate into a practical effective rate that illustrates real financial impact. For example, a nominal rate of 6% compounded monthly translates into an effective rate of approximately 6.17%. This difference might seem small, but over time, it impacts the total interest earned or paid, especially with large sums of money. Let's apply these concepts to a practical scenario. Imagine you've deposited $1,000 in an account with a nominal annual rate of 5% compounded monthly. By converting to an effective rate, you'll find your savings grow more than you'd initially expect by year's end. Incorporate effective rates into your financial planning by comparing loans, choosing savings accounts, and evaluating investment opportunities. A clear understanding of true interest costs or incomes empowers smarter fiscal decisions, enhancing your ability to plan for the future effectively. This newfound knowledge equips you to make informed financial decisions moving forward. Now that you understand how to convert nominal rates to effective ones, apply this skill to assess your financial options critically. Continue learning about personal finance and share these insights to help others navigate their financial journeys wisely. Take control of your financial future today. If you found this video helpful, don't forget to like, subscribe, and hit the notification bell so you never miss out on more tips to grow your wealth. Share this video with someone who needs a financial breakthrough, and let's achieve financial freedom together.